Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. This video on private credit investing is part of a series we call Alternative Investment Reality Check. Many investors believe that alternatives are a good way to raise returns and the diversification of their investment portfolios. As we show in this Reality Check series, alternatives have not been nearly as beneficial as most believe. Private credit has become a popular category with rapid growth in assets under management. According to PitchBook, assets in private credit have reached $1.6 trillion in the US, and that makes the category larger now than the US liquid high yield market or the leveraged loan market. The main reasons investors have been attracted to private credit are there's a much greater opportunity set. The US alone has more than 200,000 middle market businesses. The returns have been higher than in liquid credit investment categories. There's a considerable range of types of private credit investments that one can make. And moreover, there's a perception that the volatility and correlations are low, creating a diversification benefit. Indeed, the historical returns of private credit look excellent. The chart here shows the cumulative return over the past 20 years of various types of credit investments. Private credit has returned 10% per year, which is better than the 7.5% per year from the Business Development Company Index or the 6.5% per year from the US High Yield Index. But perhaps this terrific track record is an illusion. Private credit returns are reported using the internal rate of return method, which is easy to game and typically flatters actual performance. As with most alternative categories, it is difficult, painstaking work to make a truly valid comparison between private investments and equivalent liquid investments. The National Bureau of Economic Research has done that work, and they concluded that on average, the gross returns of private credit investments have been 4% per year higher than could have been achieved in similar investments in liquid credit. However, they also found that the fees captured by the private credit firms have been 4% per year. And that leaves, as they said, a net of fee return advantage to the investors, which is indistinguishable from zero. The perception that volatility is low is another illusion. As reported by PitchBook, private credit has had an annual risk of 8% per year, which is about half of the 15% per year, the S&P 500 stock index. But we can get a sense of the real risk of the category by looking at business development companies, private credit funds, which are publicly traded. BDCs are enormously risky, 28% per year risk, which is almost twice the risk of the US stock market index. BDC investors face drawdowns of over 80% during the global financial crisis and nearly 60% during the COVID meltdown. Since BDCs and private credit firms hold similar assets, investors in private credit should recognize that the potential for short-term losses is high. Is private credit even a risk to global financial stability? Recent studies by the International Monetary Fund enumerate reasons for concern. The most important one is that private credit is untested. It has never experienced a severe downturn at its current size and scope. Also, it's lightly regulated, the valuations are subjective, lending standards are deteriorating, and interest coverage ratios are falling. Moreover, the IMF wonders, rightly in my view, whether retail investors in private credit really understand the risk of the investments that they are making. In conclusion, while the historical track record of private credit appears favorable, some caution is warranted. As reported by the NBER study, there may have been no net advantage over equivalent liquid investments. There's significantly more downside risk than most believe. This category has surged in benign conditions and has not been tested in worse ones. Finally, as is the case for all alternatives, excellent manager selection is the key to success. Most investors in private credit do not have the organizational capabilities to do that well. Thank you for listening. To get other recent market commentary, you may watch the market commentary playlist on this channel, and you may also subscribe to be notified when the latest is posted. You may also visit our website at atlasca.com to have access to our investment philosophy and latest views. Thanks.